morning, everybody. Welcome. Welcome on this lovely spring morning. I hope you all can hear me well. My name's Amanda. I am CEO and co-founder of the CPD Standards Office, for those of you that haven't met me before, and a really warm welcome to you all. Today's session is around our top tips for financial success. We're delighted to have Charlie and Jeremy with us from Chase de Vere. They're going to talk through all sorts of useful and essential advice for you all. And we know that this is an area that is massively in demand for you as trainers, coaches and online educators. We know that you spend a lot of time working in your business, delivering, creating materials, etc. And sometimes the financial planning side of things falls away. So Chase de Vere have, these are independent financial advisors, and we're delighted to have you, Jeremy and Charlie, and over to you for the session.
Thanks, Amanda.
Thank you.
What I'll do is I'll just share my screen and we'll get going. So let's just jump on. So thanks for tuning in, everyone, and hopefully this will be of some use to you all. Just trying to get this full screen now. There we go. So yeah, as Amanda mentioned, myself and Charlie, we work for Chase de Vere Financial Advisors. We're the biggest independent financial advisor in the UK. And what we'll do is just have a quick look at the agenda. So we'll start by looking at managing expenditure, keeping on top of borrowing, looking at income and your protection alongside that, such as life protection and critical illness. Then moving into things like saving regularly, investing, also tax efficiency, and probably the biggest thing, and Amanda mentioned your trainers, so you'll be used to this, setting goals and reviewing them. So we'll finish up with a little bit about Chase de Vere. So let's have a quick look about managing expenditure. So this for me is the bedrock of everything. So what we'd like everyone to do when we see them as clients is obviously set a budget, then track your monthly bills and expenses. Make sure you review all of those expenses for ways to cut back, and set specific goals such as building an emergency savings fund, paying off your credit card bills, saving towards that family holiday or new car. And actually, as a matter of fact, I've just done this at the weekend because I've just moved house, so all my direct debits are all over the place in terms of new council tax, so on and so forth. And going through it is actually quite cathartic, but I'm quite a sad person, so I quite enjoyed that. So we would always encourage people, no matter what kind of stage you're at in your career or your life or your wealth, always set a budget and always review it as much as you can. Because like I said, that's a bedrock of everything. So once you've freed up that expenditure that you're not making, where do you put that? Where can you channel it? Can you put it into savings? Can you put it into protection? Can you put it into other things that will help you along your financial journey, such as pensions, so on and so forth? So we'll always say, look, just ensure you get that right and everything else will follow. That's probably the hardest thing that myself and Charlie speak to clients about. It's actually figuring out what your budget is and how much you spend. It's really difficult, especially when you've got families, so on and so forth. But if you have, I suppose, a very structured way of looking at that, making sure you've got all the basics accounted for, then everything else would be much easier than you think. So that's the most difficult one to get started. The next one we'll always encourage people to look at is review your borrowing. So make a list of what you've got in terms of debt. So mortgages, personal loans, credit cards, store cards, any overdrafts you've got in the bank as well, and that can be business bank accounts too. So this helps you kind of understand how much you've got as debt, which will then help us and also yourself realize, okay, well, if I'm not here, what debt do I need to cover on death? Or if I'm critically ill, or if I can't do my job day to day, what am I on the hook for? And what are my family on the hook for? And what do I need to do to help them not be fiscally worse off if I can't work because I'm not here, or if I can't work because I'm ill or critically ill? So that's important to understand as well. What we do quite well at Chase de Vere, which we're very proud of, is actually mortgages and mortgage advice. So all of market in terms of mortgage advice, we can say, okay, about 80 companies, not just your high street banks, building societies, we can recommend to clients. So we can make sure that if you already have a mortgage, Do you need to remortgage that? Are you on the best deal? Even if you are on the best deal, we'll tell you too. And we'll look at what you've already got and say, okay, is it good, bad, or indifferent? What do? Do you either stick or twist, basically? And if you haven't got a mortgage, again, we can help you achieve that as well. So we can help you on the mortgage ladder. And I think now with mortgages, it's so important to review what deal you've already got. And that's because of interest rates going up every so often. I think it's now 11 times in a row the Bank of England have put up interest rates, which is pretty much a record. So of course, depending on the type of mortgage you have, that might impact your saving, might impact the thing that we just talked about there in terms of budget planning. So you would kind of be pushed to try and, I don't know, maybe get better deals if you just go straight to your bank or building society that you've already got. So I would always encourage you to get independent advice on mortgages, because they can see all the sweets in the sweet shop. Whereas if you go to a bank or building society, they're very limited in terms of what they can offer you. So make sure you either go to someone like ourselves or a mortgage broker. And the best part about our deal is that we're fee free, so it doesn't cost you anything apart from time. So as I said, even if you haven't got a mortgage, we can help you with that. And even if you do have one too, we can obviously assess what you've got and have a look at it. But it's very, very important to review mortgage, because a lot of people, as I said there, are on variable rates. And because the Bank of England have put up interest rates so high now, that can really affect your budget planning. So just make sure you've got the best deal around. And if you don't think you have, then speak to myself or Charlie or someone at Chase de Vere. Okay. So we'll move on a little bit to protection. These are all very basic frameworks of what you need to do. So it's very light touch, this webinar, and we'll try and, as I said, give you the very basics. You won't get all the answers for myself today because it's very specific. At the end, you can pencil in a meeting with one of our financial advisors at Chase de Vere if you want a more in-depth approach. We'll get onto that later on. But this is the first thing to think about, which is income protection. For me, this is key, and it's basically covering your salary if you can't work because of illness. So have you had significant wage increase or other change in circumstances if you've already got income protection? So if you already have income protection, it's really, really important to make sure that it's fit for purpose. Myself and Charlie, when we see people and new clients that we look after who have already got income protection, they might have taken it out 5, 10, 15 years ago and not reviewed it. And circumstances, of course, change. So as we've already mentioned there, income might go up or down. Your work contracts that you might have might change. So you might have better sick pay or worse sick pay now. So how does that dovetail in line with the income protection you've got? And also, can there be cheaper options out there? There potentially are now, because there's a lot more companies that offer income protection. So you wouldn't believe, even though you might think, okay, well, I'm 10, 15 years older, how can that possibly be cheaper? Because I take more risk, or the insurer takes more risk on their side with me. But because there's a lot more companies around, you wouldn't believe actually how cheap income protection is these days. But we consider this essential. The best way I frame it to clients is it's a little bit like car insurance for yourself. So if you break down or you cannot do your job, it will cover you. So it will pay out a salary for as long as you're off work, okay? And as I said, if you've already got this set up, it's well worth reviewing. Myself and Charlie and other advisors at Chase de Vere, we will review that for you. That doesn't cost you anything. We'll write off to the provider to make sure you've got the appropriate setup. And if not, we'll tell you. And likewise, if you have, we'll say that's fine. But that's really important to understand that, this is probably your most important insurance in my eyes. It's income protection. It's very simple. If you can't work, you can't pay your bills, income protection will take care of that. Okay. So let's move on to a little bit more serious stuff, which is protecting your liabilities and future income. So this is all about death or critical illness. So let's imagine you do have income protection planned for and all sorted out. Is that enough? The answer is probably no, because you might have debt, i.e. mortgages or credit cards or loans and so on and so forth, and you might need to cover those as well. Again, it's important to understand what you have with your current employer. So do you have death in service with them? Do you have any form of life protection with them, any critical illness protection with them, so on and so forth? Once you understand that, then you can work around that if needs be. If you think that's not enough, or if we think that's not enough for you because of X, Y, and Z reasons, i.e. you might have children, your expenditure, your budget might be very, or your expenditure might be very high, so your budget's very low, then what do you need to do to cover that? And again, it all goes back to the first slide, doesn't it? It's all about understanding spending month to month and making sure you cover that. And if you're not here, how would that kind of impact your family lifestyle? So critical illness cover is often kind of thought about in terms of protection planning. So we will always look at that as well. So that's a form of insurance that pays out a tax-free lump sum if you're diagnosed with an illness or medical condition specified in the terms of the policy. So think of your main criteria here. So your heart attacks, cancers, strokes, those are kind of critical illnesses. It works very differently and almost independently. Well, it is independent to income protection, whereby income protection will pay out a regular salary to you. It keeps the wolves from the door, so to speak. Critical illness pays out a one-stop lump sum, and with that lump sum you can use it for anything, such as paying off your mortgage, readjusting your home if you need that because of mobility issues, paying into a pension if your life expectancy isn't degraded because of your illness. You'll still need some form of a pension at retirement. If you can't work, then that can help fund that as well. You can use it for that bucket list type scenario, depending upon your illness as well. If you want to spend time with your loved ones, your family, it allows you the flexibility. That's what critical illness does. So it allows you to kind of do things on your own terms and make sure you're not financially penalized for being ill, basically. So as I said, works very different to income protection. Both the payouts are tax-free. And the good thing about ourselves and the other independent financial advisors is that we can see the best deals around for you. So we don't have our own products. So we can say, okay, is that the right one for you? Is that the right company? Yes, no, maybe. Okay. So again, really important to think about. Quite often with critical illness, it will be tied in with life protection as well. So it would pay out on death or critical illness. But as I said, it's really important to understand what you have already with your benefits through work. And then if they're not enough, then you replace, well, not replace them, but you kind of subsidize them with these types of things, okay? Because you might already have these things from work, and just understand your workplace contract. It never ceases to amaze me, every client I sit in front of that's new, who won't understand what they have through work with these kind of things. And it might be better than you think, which is good. So that's critical illness finished. We'll look at other side of things that are less morbid, which is savings and habits. So I don't like to be too preachy on this, but it's very important that people save money, of course. That's more than stating the obvious. But what I would say is make use of what you have under your nose with savings. And what I'm referring to there is probably the banks and building societies that you already have. A lot of them now are very intuitive in terms of their capabilities with app-based banking. So you can now have things like rounding up your expenditure, which will go into a savings pot. And you can now these days, if you do online banking, very easily make a kind of subsection on your bank where you can actually create another account, which is just a savings account. Even if the interest rate is very, very poor, it doesn't particularly matter. As long as you're getting into the good habit of filtering and siphoning off money that you're not spending in your current account into your savings account, that will go so far for you, because then it can earmark things for what you want it to do. So whether it be spending on your children, holidays, university costs, leisure things in terms of activities, it will allow you to do that without breaking into your current account. And sometimes if you just do have a current account, it gets very hazy about what you're spending in terms of management and budget. And again, it all goes back to the start, doesn't it? The budget planning. So making sure you've got almost like a sub account with your bank and building society that it's kind of geared up for that. And like I said, you know, get familiar with the banks and building societies you've got. I'm a victim of that. I don't particularly know the full capabilities of who I bank with, so I try and kind of figure it out every now and again and think, okay, what have they got on the app? You know, what can help me save and what can help me kind of earmark things for the future. So it's very flippant just to say save your money, but the best way to do it is force of habit. And as I said, you know, banks and building societies these days actually do make it very easy for you to do that. Of course, now savings and shopping around is very, very crucial. So we're at a point now where inflation is double digits, interest rates, you know, if you're lucky in terms of cash savings, you're getting 3-4%. So because inflation is so high, you have to get as close as you can to inflation in cash to actually, you know, stop the degradation of your money being eroded. So it's really important now with banks and building societies to shop around with current and savings accounts, and also be cute with it. So think about your tax status, you know, think about, okay, if I'm a higher rate taxpayer or a basic rate taxpayer, how much to have in savings, how will that impact my tax status in terms of savings and interest and so on and so forth. So look at tax-free vehicles such as premium bonds, cash ISAs, if you will. But the biggest problem you've got now is, unfortunately, inflation will erode your savings, probably in my eyes, for the next 5 to 10 years, if we're lucky, more towards a 5-year than 10-year. But realistically, that's a big problem for a lot of savers now. So do force your hand to try and save money. However, on the flip side of that, the other problem you've got is making sure you don't have too much money in cash, because, as I said, we're at a very critical point in time now where savings are getting eroded daily. And although inflation will drop, so too will interest rates, unfortunately. So they will go hand in hand. So what you're getting in terms of bang for buck for your money is very poor these days, as opposed to 3, 4, 5 years ago. So let's have a look. So as I mentioned there, the alternative to saving, well, not alternative, but to supplement it, I suppose, is investing, of course. So what I've just mentioned, make sure you don't have too much in cash. And that's where myself and Charlie and other advisors will say, okay, well, you know, what do you need short term? Have we got enough in cash? And where are the cash pots for you? Is that the best cash option you've got? So on and so forth. Then after that, we try and make people invest their money and kind of get it growing, basically. So there's a few ways to do it, of course. If we look at the very basics, it's one of three. So you can either save regularly into an investment vehicle, or you can add in an ad hoc contribution, so lump sum investments. So if you've got 20,000, 30,000, whatever lying on account, you might say, okay, let's invest that into the market and try and get it growing. Or you can do a bit of both. There's no one size fits all approach, which is great, and one isn't better than the other. It all depends on circumstance. It all depends on objectives. For instance, you might be waiting for that bonus from work and you can't contribute until you get that, but in the interim you might think, okay, saving regularly, that's for me. So you could save regularly, and then you can get into good habits, as I mentioned. And again, think of saving regularly as like a tap. You can turn it on, off, up or down. There's no problems. Of course, you've got to be wary of different allowances, such as ISA allowances and pension allowances, which we'll get onto later on. But just think of it as like that. When you save regularly, you're in control. Whenever I sit down with a client who's never invested before, and even clients I look after for many years where they have, we will always, and I will always say to them, look, if you don't think you need that money for 5 years, try and invest it. And the reason why we say 5 years is because typically in that duration, you can ride out peaks and troughs in market growth and drops as well, and also making up advisor charges too. So that's why we'll say 5 years. Now, depending upon the vehicle that you invest in, you can potentially access that within 5 years. But again, if you do that and it's sooner rather than later, you could leave yourself short in terms of market timing. So for instance, if you came to me last year, 2022, and said, okay, I want to invest in January, it was looking quite rosy at that stage in markets. And then at the end of the year, he said, look, I need some money out. In that duration, that's not growth. So this is why we're saying, look, try and make sure it's invested for at least 5 years, because you will typically ride out those peaks and troughs in markets in that time frame. Okay, so again, when you've got investments, it's very important that you have a plan. Don't idly just invest and think, okay, I'm just gonna, dump my money into this product or this fund or whatever, because that won't work. You have to have a plan. You have to have a blueprint. You have to understand how much risk you want to take, what capacity of loss you have as well, how you would look at volatility in terms of, would you be comfortable if markets went up by 5% one day and then down by 5% the next? And it's all about knowing yourself and knowing your circumstances. And again, that's where we can help things if needs be, where we'd sit down with you, run through it and say, okay, what do you need to consider? What's important for you? But what we've had recently in the past 3 to 5 years is we've had a lot of volatility in markets. That's unavoidable. It's part of the process. That's the price and the ticket you pay. However, I think that on this slide, the best line on it is the final one, the final paragraph. So just to read it out, I think it's so important because I think we're all guilty of this to some degree, but avoid the daily monitoring of investments during falling markets, as this can result in an over-emotional reaction and lead to making irrational decisions. And that's so true. So I can see that getting worse as I've gone on in my career. So I've been looking after clients for Chase de Vere for 13, 14 years now. And I think now these days, the amount of communication that goes back and forth with the clients I look after, just about short duration of peaks and troughs in markets, is at an all-time high. And that's partly down to technology, of course. You can see things, daily, whereas before you couldn't, in terms of accessibility, logging into apps, so on and so forth. But I would say, again, if you've got investments that are underpinned by a plan and an objective, then it will basically offset that short-term volatility. So you have to remember, it's all about sticking to that blueprint, sticking to that plan. And if you have a bad month or even a bad year, which is what we've had recently in markets, then, well, actually, so what? If you're set up correctly and you're kind of on a journey with it, you think, okay, well, I'm invested for 5, 6, 7, 8, 9 years, one swallow doesn't make a summer. So it's really, really important to stick to your plan. And that's the biggest mistake that myself and probably Charlie will agree that we see with clients, especially DIY investors, where they'll chop and change too much in terms of, so on and so forth. So whatever you do in terms of how you kind of design your investments, if you do it yourself, if you are comfortable with that, and again, you've got to be very insightful to be comfortable, I suppose, with it, is just stick to that plan. Okay, so let's move on and let's talk about smoothed out returns. So I'm talking about setting up plans. I'm talking about sticking to blueprints, but that's a kind of idle phrase. Realistically, we've got to kind of put some meat on the bones about how this works. So typically when people invest, you very rarely would actually stick all your eggs in one basket. That's a common phrase and expression that we'll always use. And you really need to diversify your money. So you wouldn't just put all of your money into one fund. You might think, okay, well, I'm going to spread it across 5, 10, 15, 20, 25 funds. What shapes that and what drives that decision is what type of investment vehicle you've got. So is it an ISA? Is it a pension? Is it an investment bond? Is it something more esoteric, like an enterprise investment scheme, venture capital trust, those types of things? And then from that, you almost work backwards and think, okay, what choice have I got within those products? So how many funds can I pick? What type of funds are available? Are they any good? Yes or no, in terms of the past performance? What do they have that other platforms and other types of investment vehicles don't have? So it's really important to understand where you're investing in terms of the type of vehicle. As I said, all those are kind of common ones. So ISAs, stocks and shares funds, investment bonds, so on and so forth. And even if you invest in direct shares, such as Apple, BP, Shell, Sainsbury's, RBS, those kind of companies, it's important just not to hold one. Try and spread them out as much as you can. And different types of investments obviously perform in different ways over time. And I'll give you a great example. So typically, whenever people invest, you'll always be across about 4 main, what we call asset classes. So one of them is equities. So that's shares in companies that they will go up and down daily, basically. The other one is fixed interest. So that is like IOUs to companies and governments. So they're like bonds and gilts and things like that. They carry less risk than what I've just mentioned in terms of equities, because their share price, well, they don't have share prices, but it won't kind of it won't delineate day to day with that. The other one you've got is commercial property, and then the other one you've got is money markets. So think of cash accounts. And to give you the example, and why I'm telling you this is investments performing in different ways, is commercial property. So typically at Chase de Vere, we've invested in commercial property as an asset class for past 20 plus years, basically. But this year, for most risk profiles that we look after, we've actually said we don't want any commercial property exposure for now. And the reason for that is because what you can see with your eyes currently. So Commercial property, the makeup of those types of investments will invest in retail parks, business outlets, office space, university accommodation, care homes, those types of things. Also your retailers on high streets, and so on and so forth. So a lot of those areas are struggling because of things like short-term issues of Brexit, also things like COVID as well that's impacted. People not shopping, of course, university accommodations taking a massive hit too. So to kind of prove my point, if you went down the route of, 5 years ago thinking, oh, commercial property is a great asset class. I love that property fund that I've got. I'm going to put all my money in that because it's absolutely booming in terms of performance. And then without knowing, overnight, you've gone into a global pandemic, something you've never experienced before in your life. And then commercial property prices drop through the floor. If you don't have other asset classes and other kind of types of investment to pull you back up alongside that, you've lost a lot of your portfolio there, which is going to take years and years and years to kind of catch up. So it's really, really important not just to put your money in one area, but try and spread it out over different areas. Again, if you're not comfortable with that, that's fine. As long as you understand the principle, speak to someone who is, get specialist advice. That's what we do. That's our bread and butter. Not just ourselves, other independent financial advisors. What I hasten to add is independent financial advice is key, because you literally, I've already said this phrase, I always say this phrase daily, you have all the sweets in the sweet shop to choose from. If you get advice from other types of arenas, such as restricted or tied advice, typically there's conflicts of interest. They will only sell their own products, or they don't have many products to choose from. So you're already on a losing battle on that side. Whereas independent, we don't have our own products and we've got everything to choose from, which is good. Okay. So investments, it's almost impossible to put it on 3 slides about how investing works. It's so complex. However, it's just key principles that I try and hit home in these kind of webinars. So the other thing, which again is impossible to speak about on just one slide, which is why I've minimized it so much, is pensions. So pensions are obviously great. Well, I say obviously, I think they are. And the reason for it is because of the tax efficiency you get with pensions. Again, it's really important to understand what you have through work. Hopefully, a lot of people will have a workplace pension scheme. If you don't, then you'll need to inquire as to why you haven't got one, and if that's correct. Often I see that is incorrect in the case, but for the most part, companies now have a legal responsibility to auto-enroll their employees into pensions. But once you're in that, understand what it is. So this is the biggest red flag I see as well with a lot of clients I speak to who are new to me, in terms of, you've got a workplace pension. Quite often you think that's job done. It's not. You've got to understand, can you be contributing more? Which again goes back to the first part, isn't it, in terms of budget planning? If you can be contributing more, great. That's good. How do you do that? Is the next question. So do you have to speak to HR? Do you have to kind of go online to do it yourself to change your contributions? Do you have to speak to payroll? So understand that. And then more importantly is actually probably understanding the fund that you're invested in. So as I said, it's not job done once you've got a pension through work. You've got to understand what fund you're in and is that appropriate for your lifestyle and objectives. So best kind of example I can give with this is, okay, if you're 35 years old and you've just been involved in a kind of workplace pension in terms of getting it set up, then the fund that you'll be put in is what we call a default fund. So it has no, and most of them have no kind of tie-ins with your age. So realistically, because you're 35, you can't get that pension for another 20 years, even if you liked it lumped it, because that's the minimum access age for most workplace pension schemes, if they're what we call a defined contribution scheme. So if they take investment risk, so to speak. So you've got 20 years on your side there in terms of taking risk. So is it appropriate for you to take more risk when you're younger and then kind of taper that off once you get a bit older? So again, that's about understanding the fund you're in, because if the fund doesn't take as much risk as you want in the early years, you could miss out on a lot of investment growth and then a lot of money from your pension on the back end. And the same rules apply, but vice versa in terms of age. So if you're 55 and you're just going into a pension scheme because you might have changed employment or you've set one up recently, then is it appropriate, the fund that you're in terms of the risk? Is it too risky? Because if you're going to retire at 60 and then markets crash like we've had in the past few years, then it takes a long, long time to recover that loss. So will that delay your retirement? So as I said, once you're in a pension scheme through work, don't think it's job done. It's quite often not the case. It's a very minimum that you should be doing. It's then thinking about, okay, well, have I exhausted all the options here? Do I understand the risk in terms of the fund? And again, these days as well, we've got a lot more investment preferences we can choose from with funds. So do you want to take an ethical approach? Do you want to take an ESG approach as well? So some of these pension funds will have those options. So it's understanding what you've got. And if you've exhausted all those options and you still think there's room to improve in terms of paying into a pension, then do you then subsidize your workplace pension with a private pension, and how do you set that up and what's the right way to do it? So again, don't just think that's the answer, that you've got a workplace pension. I would probably estimate a very high percentage, at least 80% of people, when they get to retirement and they have pensions that aren't typically what we call occupational pensions, that are secure, or final salary pensions, these types of pensions that take risk, I would say that 80% of people, at least, in terms of what they get out of that as an income, are fairly underwhelmed with it, because you need to understand you need a lot of money in private pensions to get an income that's comfortable for retirement, or at least tread water until you get that next set of income from your state pension, if it's different ages, of course. And if you do have those final salary occupational pensions, again, are they on track? You know, do you need to know anything about those? Understand them before it's too late. It's quite often you're sleepwalking into a problem, not understanding pensions. I understand it because it's so complex. It's really, really hard to understand private pensions because of how many different types there are, how many different options you've got. And again, think about all your career in terms of your working life, in terms of you've accrued different pensions. They're here, there, everywhere. Their names change as well. And if you're not comfortable with getting that done, or you're time poor, or you just don't want to do it, please, please, please don't leave it too late. Get advice from that, because that's the worst thing you can do. Get to retirement and think naively, oh, everything will be okay, I've got these pensions. Quite often it's not the case. So they're very, very important. It's almost, as I said, impossible to kind of go through all the utterances and nuances of pensions on one slide. So that's just me trying to hit home to you about trying to review your pensions. Okay, so we've talked about different types of investments, I suppose, but let's look at the kind of other side of the coin with tax efficiency with those types of investments. So we try and do the basics very, very well, or try and educate people to do that. So every year you have an ISA allowance, okay, and sometimes it passes people by and they don't understand it, but there's a limit on that for a reason. So you've got everyone who's a UK tax resident has got a £20,000 ISA allowance. So individual savings account is what ISA stands for, which means you can put up to that much money into an ISA and you can get tax-free growth on that, which is fantastic. So you can put as well £4,000 into a lifetime ISA, which is fairly newish in terms of a concept, but you've got to be between age 18 or over to 40 to open a lifetime ISA as well. And that counts to your overall limit of £20,000. But they're your options. How you structure your money within that ISA is entirely up to you. You can either go down the cash route, or you can go down the ISA stocks and shares route, or you can do a bit of both. Again, it depends on the provider that you set it up with. It depends on their capabilities in terms of, can they allow that? For instance, lifetime ISAs, you're quite hard pushed to actually put stocks and shares elements within those. So it might just be cash you're going into on that one. But again, it's something to consider, and that's why they have limits on them every single year, because of how good they are. They're tax-free, and there's not many things that are tax-free in this life, and ISAs are fantastic, and that's why there's a deadline. And that's why I was saying before we started this, that's why myself and Charlie have bags under our eyes at the moment, because it's tax year end at the moment. So we've got a lot of people where we're trying to hit these deadlines before we miss them, okay? But you've got all year to use it, so just remember that. But as I said, don't let it sell you buy, because they're fantastic. Tax-free growth is not to be shirked at. So, other thing to go through is if you do already have investments that aren't within ISAs. So, if they're held outside an ISA or a pension, unfortunately, these will usually be subject to capital gains tax when they're sold or given to someone other than your spouse. So the gain is usually calculated as the sale of the proceeds less the purchase costs from assets, and it's taxable at 10% if you're a basic rate taxpayer, or 20% if you're a higher additional tax rate payer, except for residential property where the rates are much higher. So those go up by 8% either way. So your 10 goes to 18 and your 20 goes to 28. So if you do have products that you have purchased in the past, such as investment funds or other types of things that are out with your tax allowances, think about, can you take them and bring them into a tax efficient environment? Can you move them into an ISA, yes or no? And again, that's part of the job that myself and my colleagues do at Chase de Vere. Look at the whole picture and say, look, what have you got? And is it the most tax efficient? Because it's all good and well investing. It's all good and well trying to grow your money above and beyond inflation and interest rates and cash accounts. But actually, are you losing some of that because of tax? So it's really important to understand that. And there's something that's kind of slipped a lot of people by recently, which is the change of this thing, which is capital gains tax. So your allowances are really getting stripped down over the next few years. So if we look at this tax year, we've got 12,300 is what you can make as a gain in something that isn't in a tax efficient product like a pension or an ISA before you pay tax on it in terms of the profit. So 12.3 is quite high, especially if there's two of you in a household and you've got joint kind of investment. But unfortunately, that's reducing to £6,000 next tax year. And then the tax year after, it's going down to £3,000. So if you have these types of portfolios, that really needs to be a kind of alert on your kind of side of things of thinking, well, what do I do? And how do I play this going forward? And that's the same with residential property as well. That, I'm assuming, won't be tax efficient. So how do you actually kind of, leave yourself wiggle room if you're going to sell your second properties in the future, and kind of if buy-to-lets are being sold and so on and so forth. So just be cautious of that, because that slips under the radar recently with a lot of people, because there's been so much in terms of budget announcements and everything else alongside it to really pass people by. So don't let that catch you out in the future. So as I said, it's going from 12,300 this tax year, so up until April the 6th. And then we're going to 6, and then next tax year we're going to 3. So not a lot of wiggle room going forward. So just be cute with that. So fail to plan to fail. Love it. That's what we've got to remember. So again, we'll see this every start of the year, and I still say we're probably early on in the year at the moment, being March. But whenever we see clients at the start of the year, everyone's and I include myself in this, set off with the best intentions in terms of their plan. So okay, I'm going to do this, that, and the other this tax year, and quite often it falls by the wayside. But be clear on your goals every year and think, okay, this year financially, what can I do? And it doesn't matter what age you are, it doesn't matter what demographic you are, it doesn't matter what you do for work, it applies for the same person and people. Just remember your goals. Remember, okay, this is what I need to do with my finances this year. What can I be doing? Can I be saving up for that? Do I need that in the future? Can I be investing? What's my budget? And times are tough at the moment, I know that. But again, it all boils down, again, doesn't it, to the first slide. Think about your budget. That's what shape your financial future. And even if you think it doesn't have a big impact because of, it's years and years away before you retire or do what you want to do, it will compound every single year. If you don't budget plan, if you don't understand what's going in, what's coming out, it will really degrade your finances. So refocus on your goals, try and make clear decisions. As I said, with the investments, don't be hasty as well, and review what you've got. It's really important to actually understand what you have. So what I mentioned before, the income protection and life insurance, you've got critical illness, try and review those. And again, make sure you've got adequate emergency funds there, because don't leave yourself too short. Your mortgage, try and review that. The other thing that we won't hassle people about, which is good, but we bring it up anyway nonetheless, is wills and powers of attorney. We're not solicitors at Chase de Vere, far from it. We're financial advisors. but we need to make sure that people have got the right will set up and the right powers of attorney, because unfortunately we deal with all the fallout when you don't have those, in terms of family, in terms of squabbling, in terms of ease of access. So it's so important, and we just wish that people would have made them beforehand. So please do make sure you get your will set up, and don't rely on the ignorance of thinking, oh, it'll all be okay, you know, once I've passed away, because quite often it's not, I'm afraid. So review those as well. And as I said, with your pensions as well, please try and get those reviewed and try and understand them at least. I appreciate they're very, very complex, but please do try and just, you know, at least have a look at what you've got, and at least understand what you've got and where it is, okay, at the very least. So let's have a quick look about us and financial advice. So financial advice is quite alien to a lot of people. If we think about traditionally, probably before the financial crash in 2008, a lot of people would have constituted financial advice as going to your bank or building society, and quite often you could get away with doing that. However, what you probably didn't realize at the time was they will only sell their own products, and they're fairly limited in the advice that they can give. Now, fortunately, since then, a long time ago, there's new kind of rules and regulations that have come into play, and it means that now financial advice is, you know, really kind of upturned in terms of people being aware of it, which is key, because as I said, if it is independent financial advice you've got, you really will get good value from it, because it saves you time, reduces your noise in terms of trying to figure out, again, investments are a key kind of example of this. Trying to figure out where to invest is just an absolute minefield from start to finish. And that's why we do so many exams per year. And myself and Charlie have done that throughout our career in terms of keeping up to date with rules and regulation, investment types, and so on and so forth. And unfortunately at Chase de Vere, you know, we've got a huge team who just manage investments solely. That's their day job. You know, they sit in the basement, they don't see the light of day every day. That's all they do, analyze and scrutinize data. We cannot do that ourselves, myself and Charlie. So we have a team at Chase de Vere which should actually demonstrate how difficult it actually is. If independent financial advisors don't have the time to do it, they have to, you know, offset it to a team within Chase de Vere to do so. That kind of goes to show how complex it is. Again, as I said, mentioned before, goal setting. We can help you with that. So we can say, look, what do you want, and what do you want to achieve? When do you want to retire by? And on the back end as well, it's something that we've not mentioned in this webinar, but inheritance tax is key as well. So, you know, is that a goal for you? Do you need to think about, okay, now I've accumulated all this wealth in my career and my lifetime, how do I actually get rid of that? Is that an investment goal for me in terms of what do I do? You know, how do I gift? How do I kind of spend money? And how do I decumulate my wealth? It's very easy to say, oh, I'll just spend my money. But it's actually very hard to do that without, you know, compounding a problem for inheritance tax too. So it's not just the kind of pre-retirement, so to speak, it's also post-retirement where we can help, and also long-term care planning as well. Get onto that in a second. But and yeah, so financial advice is, as I said, it's very bespoke. It's not an off-the-shelf product. It's all dependent upon what you have and your objectives and circumstances. And thankfully, myself and Charlie have been doing it quite a while, so we like to think we know what we're doing. But Chase de Vere have been around for quite a while too. So I didn't actually know that until I saw the picture here. So we started before the first man walked on the moon. So that does go to show we've been around for quite some time. So since 1969, we've got more than £9.8 billion worth of client monies that we look after. We actively advise more than 1,000 businesses and 15,000 individuals, and that's something that's not even touched aside on this seminar in terms of a business and corporate advice. So if you have a business, we can help with that in terms of reviewing, you know, what your setup is with workplace pension schemes, what your setup is with life protection and kind of benefits within the businesses as well, and how, you know, you might help yourself as well in terms of financial advice from the business to an individual basis too, in terms of tax planning and things like that. So we can help with corporations too. We've got numerous business partners who advise to trust their customers and members. One that jumps off the top of my head is the British Medical Association. So I'm assuming quite a lot of people will know who they are on the webinar. So yeah, we're trusted by the BMA basically to give doctors financial advice. So we have a lot of large organisations that we're linked with. And we're regularly in the media too, so you'll always see our name splashed across the Sunday supplements in terms of asking for comments, so on and so forth. And as I said to you before, for me, this is the biggest part, and this is why I do what I do, and especially with Chase de Vere, it's independence. So I know when I sit in front of a client, their interests are always on the forefront of the advice in terms of that's what we have to kind of make sure is important. So we've got to think, well, how do we help and how do we create the best value for a client? And it is independent advice without a shadow of a doubt, because otherwise, as I said before, you're fighting with one hand tied behind your back in terms of when you give advice. If you're a restricted advisor, if you're a tied advisor, you can't give great advice to clients, whereas we can. We pay a hell of a lot of money to do that in terms of regulatory fees, but we think it's more than worth it because we think it is the right advice in terms of when people get financial advice. It's all bespoke, it's all independent, and that's what it means to you basically. We'll always find you the right solutions. We've won a few awards along the way, so those are the ones there. I won't kind of go over those. And the biggest part for me as well, not just the independent part, is we're holistic. So that's a phrase that's bandaged around, doesn't really make a lot of sense to clients until we explain it. But what it means is we won't just focus in one area. So for instance, if you came to us and said, look, Jeremy, Charlie, I want advice just on pensions, by all means, we can give that. That's not a problem. That's fine. But what you as a client and as a customer, as a person has to understand is that if we give you advice on pensions and we don't see the full picture, then what that could potentially create is a problem in another area. So if we think, okay, well, we'll do this pension planning for this person over here, we might have we might be solving a problem, but creating another one too. So we need to see everything under kind of one roof. So we need to see all of your circumstances because it does have knock-on effects of one another. It's very much like you go into a GP, and if you said, look, you know, I've got a knock on my knee, and then GP would say, okay, well, you know, I can give you some tablets and some pills that help you with that in terms of anti-inflammatory, and away you go. But if the GP didn't ask you how your overall health was, you know, are you having any headaches? You know, what's your eyesight like? How are you feeling day to day? Then they're not doing their right job. And it's the same with us. We've got to understand the full circumstance of each household we walk into. And it's not just you, it's your family. So your wife, your husband, your boyfriend, your girlfriend, even if you're single, it's making sure that you've got that kind of cover and all the kind of areas that we need to know. We need to make sure and understand you fully before we give you any advice, and that's just trying to embed as much value as we can into what we do for you. And as I keep mentioning, we're bespoke, so we don't have a kind of off-the-shelf recommendation. We're not like that. We don't think that's right for clients, and that's why we don't have that mantra, quite frankly. I've already mentioned a few of these, but just in case I missed any off, estate planning is one that I've mentioned late in the day on this one, but there's also other things as well. Long-term care we can help you with, tax planning, educational funds for children, grandchildren, even yourself perhaps as well. So we can help with that in terms of figuring out what's the right solution for you. So just finally, our approach on things, what we do is how it kind of tends to work is if you do want our help, we will meet you either face-to-face or over a video call, telephone call, whatever's easier for you. Even if it's popping into your place of work, that's not a problem with us. We can do that too. That's fine. So we'll meet with you. We'll have a chat. We'll have the discussion. We'll see what you've got, what you need help with. As I said to you before as well, if you do have any types of products such as income protection, life protection, pensions, investments, anything that you've already set up, you know, however it's been set up in the past, whether you've had advice before, whether you've done it yourself or whatever, however you've accumulated that, if you've got them and you don't know what they are, then what we will do is we will write off to those providers for you and find out. And we can't do anything until we do that, basically, because there's no point of us going gung-ho into a setup to say, oh, by the way, you need life protection, or, you know, you need the pension, and not understanding what you've already got. It'd be remiss of us to do that. So what we will do is we will write off to those providers for you. That doesn't cost you anything. The reason why it doesn't cost you anything is because we need to understand what you have before we can actually then make a recommendation to you. At that point, when we make a recommendation, we will say, okay, if you want our help, it'll cost you X, Y, and Z. and that's the service that we give you. It all depends on what kind of area we give advice on as to what the fees are, and again, what the service is. And we don't just leave you high and dry. So once we've set the things up that you want, we don't just then say, okay, you're on your own, goodbye. Far from it. We're always at very minimum arm's length in terms of saying, look, have you done this? Have you done that? We can often meet with you on a review meeting once or twice a year, if not more. It all depends on what you want from us as the service we give, but we've got all different types of service. So as I said, we'll never just leave you high and dry and say, okay, that's it, goodbye. We're always at arm's length at a very minimum, okay? And again, it's a kind of general theme of this seminar, but it's important that you review things. So that's the key to it. It's not just setting things up and think you've done it, because circumstances change. As I've already mentioned, kids, new house, move, new job, new salary, all that will impact everything you've got in your day-to-day life with finances. So it's important that you've got a review in place in terms of, okay, sitting down with an advisor, is this right? Is it wrong? What do I do if needs be? If you do want help from us, the first meeting doesn't cost you anything. As I said, even if we write off to the providers for you, that doesn't cost you anything. And we'll get to a stage in the road where we'll say, look, this is what we'd recommend. If you don't take our advice, fine, you're under no obligation to do so. If you don't take our advice, we don't retrospectively bill you for the time we've put in. We're not like that. Until you sign something, you owe us nothing, basically, is the best way to look at it. We're so transparent, and rightly so, because of financial conduct regulations. But if you do want a review meeting or kind of just a chat, there's a QR code here, and I think if I click on this one, it's a bit bigger. If you can scan that on your phone, fine, not a problem. It'll take you to a website, and someone will be in touch to book you in with an appointment with one of our advisors. If you can't use QR codes, I'm going to, unfortunately, Kirsty and Amanda, put the task to you to forward on some contact details for us. But I think that's pretty much me done. So I'm going to stop sharing now, ladies, if that's okay. And I'll try and put my video back on for Q&A now. So is that okay for everyone?
That was great, Jeremy. Thank you so much. And I think, there's such a lot of detail in there and such a lot to think about. Has anybody got any immediate questions for Jeremy and Charlie at all? I know we've covered quite a broad spectrum of different areas of financial planning and thinking through things for the future. We've got any particular questions coming through? We can either put those on the chat or raise your hand and ask a question directly. One of the questions I had, and maybe I didn't understand this entirely, but early on in the session you talked about income protection and critical illness cover. Now, a number of our community are self-employed, and many will have a sort of range of what we think we're going to earn as a trainer, as a coach, as an independent, but it's not necessarily fixed, and some years will be better than others. So I just wondered, how does income protection work from that perspective for everybody who's out there as an independent, either registered as self-employed or as a limited company?
Charlie, you gonna got me to?
Yeah, crack on, Jeremy.
Okay, so that boils down to reviewing again, I suppose. And I've literally just had this issue with one of my clients recently, whereby her salary has gone down by more than half recently. So when she set up the income protection originally, it was basically the maximum that she could set up against her salary. Because what you have to realize and understand is a lot of the insurers will only say, look, we will cover you for X% of your salary gross, which is about 60%, give or take, at the highest. Okay, so if your salary comes down, of course, then you're paying premiums for something you might not get back as a return to cover payout. So you've got to review it every single year, and also take, I suppose, a pragmatic approach to it. Because again, going back to that example there with the client I look after, we've known this for about 3 years, that her income protection is actually too high versus a salary, but there was potential for her to actually go up in terms of hours in the future. So we've almost been hanging on until we've got a kind of definitive answer as to whether that's going to happen before making a recommendation about what to do. We've now got that because you're not going to go back to work. So what we've then done is gone to the insurer to say, okay, this client now has this amount of income. So how much cover can she get based on that level of income? Then what the insurer will do is almost like an adjustment quote. So they will say, okay, we're going to decrease the cover based on a new income. And because of that, the cover amount will go down because she's paying for less, basically. So the premium that she pays will go down every single month. Now, you can't go the other way, which is the annoying part. And this is why we had to hang on. Because if she hypothetically did that in year 1, and then in year 2, given your example there, went up again, she can't then just pick up the phone, or we can't pick up the phone to the provider to say, oh, by the way, their salary's now gone up, she wants the same amount as before, because then you have to go through another application. And then
so you can sort of review it on your annual date of renewal, as it were.
Yeah, I would say just be pragmatic with it, though. And you're right, it all depends on employment circumstance too. So it might bounce around in terms of, you know, am I taking this amount out from a limited company in terms of dividends, salary this year, next year, whatever. But again, it's all, there's no kind of right or wrong answer with it. It's just trying to review it as best you can, but also understand that that does need to be reviewed as well. Because if you just think, okay, well, my salary's gone down, my income protection will still pay out the same amount, and vice versa too. So if it's too low, and then you think, oh, okay, I've got income protection, and actually your expenditure is much higher than it once was, and it's not going to be enough cover, is it? So it's difficult to answer that in a very short sentence. Is probably what I'm saying.
Understand. Yeah, it's just something, you know, that's a conversation at the moment. Does anybody else have any questions at all? Well, we covered such a lot of detail. Okay, well, we'll draw the session to a close. So Jeremy, Charlie, thank you so much for such an informative session. The details are on the slides, which we will circulate, and we will forward any inquiries to you that we get through. Anybody that's got any questions about their assessments or membership, please do get in touch with your account manager, Rachel Ward, Richard Isaac, or the assessments team here at Assessments at CPD Standards. But thank you all for attending this session this morning on this lovely, bright Monday morning. Thank you again, Jeremy and Charlie. Have a great week, everybody, and we look forward to being in touch soon.
Thank you.
Thank you.